Hello and welcome everyone to the session on statistics on investments firms. My name is Matthias Nöckel from Deutsche Bundesbank, and I'm happy to introduce you to this topic. The first thing I wanted to show you is the structure of the euro area financial sector, and especially the development between 2008, the start of the financial crisis, and 2018. What we can see on the yellow area is that the role of banks, the MFIs, monetary and financial institutions, is strongly decreasing. This is mostly because the returns on deposits in banks are highly correlated with the interest rate the central bank is setting, meaning that they strongly decreased. Whereas, on the other point, the green areas, investment funds and other financial institutions doubled their shares in the financial sector, which is then mostly because their in return is not so sensitive for the interest rate of the central bank, meaning even if they are in a low interest rate environment, they can still give you higher returns compared to classical banks. And what we can also see is that the total assets of the euro area financial sector amount to 67 trillion euros in 2018, whereas the GDP of the whole euro area in 2017 was only 50 trillion, meaning that we have a 5 times higher total investment sector than we have GDP. Also highlighting the high importance of the financial sector in the euro area. So let us now come to the question of what is an investment fund. The definition of an investment fund is that it means a collective investment undertaking that invests in financial and/or non-financial assets, for example real estate investments, to the extent that its objective is investing capital raised from the public. Not included are pension funds and so-called money market funds. What exactly are money market funds? Money market funds are a kind of mutual fund that invests in highly liquid near-term instruments, and they are part of the monetary market sector or the money market sector. So you see, one differential between normal investment funds and money market funds is that money market funds typically invest into assets that have a maturity of less than 3 months, mostly even overnight investment, cash for example, meaning that it's highly liquid, whereas normal investment funds typically have higher maturity rates for their investment. They have a higher investment horizon. What are the reasons for investing in investment funds? One point is, of course, economics of scale, because the higher your investment is and the higher the sourced investment of the fund together is, the lower the transaction costs are. Another important point is that you increase the diversification. If you yourself as a person would invest in 2 or 3 things at a time, you can only diversify between all these 3, for example. If you then go to the investment fund and the fund is investing into, say, 20 countries with 1,000 investments in each country, you have a huge diversification. So if one country or even the euro area, for example, would get into economic problems, this does not effectively get into the return of the fund so strong as it would have for your own investment, especially if all of your 3 investments would have been in the euro area. And another point is you have professional investment managers, which might potentially be able to offer, on the one side, better returns because they have more experience, they have more software tools and so on to use, and they can make a more adequate risk management, as I said, for the diversification, for example. So another important question is, what is the total instrument breakdown in the investment sector in the euro area? As you can see, our data is from 2018. So we have different products on the asset side. The question, what are the investment funds investing into? You have, for example, deposits into other institutions, banks, other funds, and so on, and individual loans claims, which only account for 7%, so not a lot. Then you have debt securities, which is the biggest share. Debt securities are securitized projects, structured projects which you can buy. For example, these famous projects from the subprime crisis in the US. So you have a product, a share onto a structured product maybe, which accounts for several million credits, for example. Also in the phase of diversification, this is a meaningful and sensible investment because you have single risky investments with a higher return, yet you have a broad diversification over a lot of single instruments, meaning that the risk is also decreasing. Then you have equity products, which is, I think, obvious. Funds buy the equity of big firms, companies, for example. So investment funds, for example, buy DAX shares from DAX companies in the euro area, or to say in Germany at this point. Then you have investment fund and other money market fund shares. That's, of course, what we see on the liability side as well. Investment funds and money market funds get their money, their funding, mostly to 90% from giving out shares. And these shares, of course, are bought from other investment funds because they are also an interesting investment. And again, you have a diversification aspect. You diversify your portfolio through the use of other investment fund shares who are specialized maybe in other things, maybe in real estate investment or something like that. Then you have non-financial assets. For example, funds could also be specialized in the investment of corporate buildings or something like that, real estate investment. So this accounts only for 3% since it is a very specialized form of investment. And then we have other investments which are not mentioned in the beforehand mentioned points. What are the liabilities? As I said, investment funds take 90% of their funding from giving out shares. So the investment fund is built up and then it gives out shares to private persons, to other firms, to other investment funds and so on, meaning that the money they get for these shares is their capital. 4% account for deposits and loans taken. And in some points, these are, for example, deposits or loans from their management companies or from the banks that build up the investment funds. And then you have 6% other liabilities. We now come to the legal background and reporting of the investment fund statistic. The investment fund statistic is currently built up as the monthly and quarterly statistic. It was first released in December 2009, where you can see the idea of the investment fund statistic in raising this data originated from the financial crisis in 2007 and 2008, and mostly because investment funds in subprime mortgages were the main reason of this crisis. The general legal background is the same as for most of all statistics in the ECB, I would say. First of all, you have a regulation, which is a document that is going out from the ECB or the ECB to the reporting agents, where you force the reporting agent to report to a national central bank. Then you have a guideline which is amending that the national central bank has to report its data to the ECB, and of course it's defining how this reporting, this secondary reporting is going on. And then we have a manual of the investment fund statistics, which is based on the investment fund regulation and the monetary and financial sector guideline, which is not legally binding, but which is mostly for the clarification and the understanding of the statistical requirements to the reporting agents. So it's a document that is helping the reporting agents to understand how and what exactly they have to report, because the guideline and the reporting regulation are not so detailed, and it's not so easy to understand every use case of the statistical reporting in this point. So what are the main features of the regulation? The general feature is we introduced a security by security reporting in order to minimize reporting burdens. The frequency is different for the different instruments. You have a monthly frequency for investment fund shares or units which are issued, but we have a quarterly frequency for the detailed assets and liabilities of the fund itself. All data are end-of-period stock data and revaluation and adjustment transactions, where they are applicable. The deadlines are the 28th working day following the end of the reference period from the NCB to the ECB for the monthly and quarterly data each. In the investment fund statistics, we have a so-called combined approach, meaning we combine granular and aggregated data together. We have a granular security by security information reporting on the individual securities data, and we have aggregated information for all other balance sheet items. What is exactly to be reported from the individual investment funds? First of all, you have to report a so-called security identification code, which is mostly the ISIN, which is used in the euro area. And then you have to report 2 out of the 3 following points. Either the number of units or aggregated nominal amount, the price, and the total amount. The idea behind having only to report 2 of these 3 is that if we as the central bank, we know 2 out of these 3, we can calculate the third one. The aggregate information is the outstanding amounts of stocks and the adjustments and transactions. And if you are in non-compliance, of course, there is also information from the ECB and the guideline as amended. The data is then reported in 2 different tables. The first one are the quarterly stocks, the revaluation adjustments, and the reclassification adjustments of your investments. The second one is the monthly stocks and also, of course, the revaluation adjustment to these and reclassification adjustments. But then again, also sales and redemptions of the investment fund shares or units issued. For security by security data provided to the NCB, we have aggregated data derived by mapping the security by security information to information available in the centralized security database, of which you will learn in the 3rd block of the EMOS lecture. Then again, each of these 2 tables is to be provided for 12 subcategories. First of all, the investment funds are broken down by the nature of the investments. For example, equity funds, bond funds, mixed funds, we have real estate funds, hedge funds, and other funds. As of which category, separate information on exchange-traded funds, so-called ETFs, and private equity funds, if available, are required in the guideline. Each of them is further broken down by the type of the investment. For example, open-end investment to close-end investments. Equity are typically, for example, open-end investments, where credits, for example, are closed-end funds because you have the maturity of a credit or you have the maturity of a bond, for example. And then we have UCITS and non-UCITS funds, split added in 2018 in the guideline update. UCITS funds are a special type of funds. UCITS stands for the Undertakings for the Collective Investment in Transferable Securities. They are perceived as safe and well-regulated investments and are popular among many investors looking to invest across Europe because they are allowed to sell cross-European mutual funds. Another important definition is what exactly is a hedge fund. We have some common characteristics used as the basis for statistical definition. Hedge funds apply relatively unconstrained investment strategies, so they have not one single objective in their strategy, to achieve positive absolute returns, and whose managers, in addition to management fees, are normally remunerated in relation to the fund's performance, which is not given for normal investment funds. There you only have a fixed fee for the management. Other criteria which are not included in the official hedge fund definition are, for example, the investors in hedge funds who are normally or typically regulated. For example, you have to give a certain minimum amount of money to the hedge fund, say several millions, because they are more risky in their nature and they do not want to give this risk to normal people with only a small amount of investment, where deficits in the returns or even losses would give more pain to the people, so to say. Also, you have special withdrawal or subscription definitions. For example, the withdrawing from a hedge fund is much more expensive in kind of fees, or it is even prohibited by the fund itself, and the subscription also. And then again, as we said, for the remuneration of the hedge fund managers, most of the hedge fund managers typically also put their own capital into their hedge fund, which is not given for normal funds. What I wanted to show you now is the distribution of investment policies in the euro area. What we can clearly see is we have two champions in the European market: bond funds and equity funds, both investing into very long-ranging, or even for the equity funds, into investments which have no maturity at all, meaning they are very safe, they have a very constant return rate normally, and they are very long-ranging. For example, if you as a person want to invest for the next 20 or 30 years into something. And then the third block are mixed funds, which are a mixture of all the other funds, mostly again from bond and equity investments. And what we can see, equity, bond, and the mixed funds account in total for 82% of all investment fund shares in the euro area, meaning the euro area society mostly invests in very conservative and safe assets. Where opposed to this, the real estate funds and the hedge funds, which are more specialized or more risky, only account for around 4 or 5% of the total shares, meaning we are also very conservative in this view, that we do not want to invest in the more risky assets which may or may not bring higher returns, but also have a higher volatility in their returns. Another important point I wanted to show you is data on so-called ETF funds. ETFs are exchange-traded funds, meaning they want to mimic a certain index. Normally, they are not completely reproducing the index because on the one side, the assets in this index, meaning the equity of the companies behind the index, for example, for the DAX index, is not so publicly available, especially not in these high amounts as you see here. If we would reproduce every index with each ETF, this would mean that we would raise the prices of the equity behind these firms by a high degree. Another important point is that through the reproduction, meaning synthetically, the funds invest into different assets which are highly correlated with the index itself, yet they are not included in the index. This can sometimes even get you to the point where you participate from the upswing scenarios more, meaning you get even higher profits when the index is increasing, and you participate less from the downswing perspective, meaning that if there are losses, if the index is decreasing, the ETF index itself, which is synthetically built, is not going down as much as the index itself is. What we can clearly see now on the left-hand side for the euro area is that the investment fund industry itself, especially for ETFs, is very concentrated in two countries, Ireland and Luxembourg. This is mostly due to the fact that the administration and reporting burdens for funds are much easier in these two countries, meaning that it is cheaper to set up a fund in Ireland or Luxembourg. Another point again is that also countries like Germany or France invest less of their income and their capital into ETFs and other funds, meaning that there's also less investment activity from the public in these countries. The other point is we wanted to show you the timeline starting from 2013 to 2018. And what you can clearly see there is that the share of ETFs on total investments in the euro area increased about 50% in only 4 years, meaning ETFs become more and more interesting for the public and more popular. You can also see if you look in newspapers or social media where ETFs are very pushed. On the last slide, I wanted to talk about the future developments of the investment fund statistics. One thing we want to capture in the future more and more and better is private equity funds data. The private equity funds are funds who channel money in order to finance private investments, meaning that, for example, if you are an entrepreneur and you want to start your idea, besides going to the conservative side, the banks, to finance your idea and to start your company, you can also go to a private equity fund and get financing through them. Meaning this is on the individual level a very risky investment, but on the other side you have a very broad diversification about a huge load of different companies. The data is so far collected on a best effort basis under the guideline, yet so far no data has been published because we have data quality issues under assessment in these statistical areas. Another point is issues and redemptions. What we want to do is to have a more visible publication of issues and redemptions inside of our data, meaning that the researchers who want to use our data have more information about issues, data quality issues, for example, or redemptions in the data itself. So we want to publish more metadata on the statistic itself. The last part is a review of the investment fund regulation and the monetary and financial statistic guideline requirements. The last update was in 2013, meaning we are now 8 years in the past. Investment funds are becoming increasingly important, in particular for financial stability analysis, the so-called shadow banking sector, which is also going to private equity funds, as I mentioned earlier in the slide. The assessment is what data on the investment funds is needed for the future to fill data gaps and to see, for example, future financial stability problems which we do not know about now, but we want to have a broader picture of the sector, meaning we as the ECB together can analyze this on a better way. So now our lecture comes to an end. So I hope you all stay healthy and I wish you a good week.